So as we're trying to get a gauge on what's happening with the real estate, the third worst performing S&P sector for the month. But how much of this is about rising interest rates versus, say, other factors at play?
Well, thank you for having me. It's nice to be here today. The underlying fundamentals of real estate are quite strong. What has happened in the real estate industry over the last year, we really had a tale of two markets. The first half of the market for the private real estate sector performed very strongly, whereas the second half of the year, we saw the market capitulate to what was occurring with the Fed's movement of interest rates. So what we've seen is a fallback in pricing, but what has endured are the fundamentals. We are sitting here today with some of the strongest underlying fundamentals in three of the four major sectors that we've ever seen. Vacancies, we finished the year in 2022 at 5.3% vacant, which was the lowest vacancy on record since keeping records in 1988. In addition to that, we saw the highest income growth for the real estate market for the year, 7.9% that we'd seen historically, except for a small time during the recovery from the pandemic. So what we're seeing here is market pricing changing as a result of the cost of capital changing, but still strong underlying fundamentals excluding the office sector.
So as we look at the four sectors, you mentioned office there. You also have residential, industrial, and retail as well. Talk about residential in terms of where you see house prices going. And perhaps you also mentioned the role of millennials in your notes and how they're going to be affecting the housing outlook.
Yeah, so millennials have been a big part of the story over the last year as housing formation increased materially over the trend. I think that will continue. But housing prices are a bit challenged as a result of the cost associated with owning homes, in particular, the cost of mortgage financing, which we think bodes well for the rental market, both the traditional multifamily rental market as well as the single-family rental market. We have seen, however, some slowing, and I would call it more normalization, frankly, of demand in the rental market here as consumers, as renters, as homeowners are starting to feel the cost of increased goods and the cost of increased mortgages around the housing market.
And I want to ask you about the increase that we've seen in cash buyers. Bloomberg reporting that over 50% of the 13 cities that they were looking at in the Southeast, which we know was a hot market, especially during the pandemic, but seeing less institutional investors. What are you seeing in terms of the balance between, your regular, person trying to buy a house versus some of these institutional investors?
Yeah, so it stands to reason that if you think that mortgage rates are up temporarily, that if you can afford to buy a home unleveraged, you would buy a home unleveraged and then leverage it at a later date at the point in time when financing costs are significantly less. The institutional investor today is really historically has looked at real estate more as an income and diversification play and has been lower leveraged and sometimes no more than 15 to 20% leverage total in their underlying core real estate portfolios. So leverage has less of an impact on them in terms of their ability to participate in the market, but it obviously has an impact on the cost of capital and therefore the swings that we would see in the overall values associated with the real estate market. And as a result, flows have reversed in the real estate market from the first half of last year, where flows were still coming into the market, to the second half of last year, where flows were coming out of the market. That was partially due and mainly due to the performance of real estate relative to the other asset classes. The institutional market has become over allocated to real estate relative to their stated targets, because of the performance of real estate relative to the other asset classes.
And just quickly, I wanted to get your top takeaways. Office and retail. We know you're bullish on retail and bullish on office, but overseas as well.
Yeah, so I would say that we're bullish on certain sectors of or subsectors of the retail market. We like the neighborhood shopping center market, necessity-based retail. We think is has a very has a place in the portfolio today. That's for a couple of reasons. One, we've seen very strong performance in grocery-anchored neighborhood centers. The vacancy levels are lower than they've been in 17 years, and you see a lot of service-oriented retail in neighborhood shopping centers, which is very difficult to disintermediate through e-commerce. On the office side is, for the most part, is very challenged, but you can't necessarily eliminate all of the office market or all office buildings from a portfolio. There are areas with strong job growth and strong population growth, and the best-in-class office buildings within those markets are still performing reasonably well. But it is clearly the worst performing office or worst performing sector out of the four currently, and we expect that to continue. In the U.S., we have vacancies today that are high as they've been since the 1990s S&L crisis, and we expect throughout the year that they will eclipse the S&L crisis vacancies and hit peaks for vacancy as a result of, one, it is the most correlated to the business cycle, and as we head into a slower and slowing business cycle, we expect it to underperform. Right. And then obviously the hybrid working or work from home environment has an impact as well on demand for office. So we do expect office to trail the other three major sectors, and we expect to be underweight, but where we will own office is in, again, those cities and areas that have strong job and population growth, and will own the best-in-class office buildings in those locations.
It's certainly important not to, look at the real estate as one monolith. Certainly a lot at play here, and as you mentioned, that weakness that you're seeing in the office sector. A big thank you there. DWS Group Co-Head of Global Real Estate, Todd Henderson. Thank you so much.